Agribusiness Report. I'm Tony St. James. We're joined today by Bob Maurer. Bob's with Manduca Trading in Chicago. Bob, welcome back to the show.
Hey, Tony. Thanks for asking me. Glad to be here again.
Okay, let's start USDA with a much-anticipated report on Friday, and I guess the reason why it was so anticipated is it's the first one we've had since the end of the shutdown. So when you start looking at it, it seems somewhat bearish to me when I looked at the corn numbers. But on Monday, we saw a rally in the corn market.
Well, you're right, and it depends on which perspective you're looking at, because the numbers did come out, and they were bearish in as much as the USDA increased the corn U.S. crop production forecast compared to the September report 2 months ago. But once again, it's all relative, because obviously we go into these reports built with some kind of built-in expectations of what the number is going to be, and the market tends to trade to those expectations. And then when the USDA comes out and actually gives the number, we tweak our opinion from there. So, yes, the corn numbers were higher than the September USDA numbers, but they were lower than the average trade guesstimate. So I guess it could have been worse, is the theory, and then the market pops up. So that's kind of what happened in the story in corn. Now, I don't know if it's going to be a sustainable rally, because still global supplies, as indicated by the USDA right there, are increasing, and it seems like we're not near as tight a situation as we could have been, as fearful as the market was kind of pricing in things maybe, 8 weeks ago or so, with the weather that we were having and some of the yield nightmares that we were hearing in certain parts. But, that being the case, we did get a little pop in the market on Friday because it was lower than expected when it comes to the numbers there. And then today we're able to climb a little bit more, gaining about 8 cents in that D's contract and up 8 again in the March contract. So that's the story right there for corn. Soybeans also, it depends on what you're looking at. Granted, the USDA did raise soybean production also in cotton, throw that one in there too. But nonetheless, it is something you got to look at relative to expectations. And in that one, the number that was zeroed in on for soybeans, 3.258 billion, was an increase from September's USDA report, and also was an increase higher than expected from the average trade out there. Now, what's interesting about soybeans is, even though that's the case, with the actual production number here for the U.S., the ending stocks forecast, once they did all their math and all the voodoo when it comes to the supply side and the demand side of the equation, came out about as expected at 170 million bushels from the USDA versus trade guesstimate of 172. And I think that the trade is kind of zeroing in on a relatively tight market for soybeans right now, and especially for soy meal, when you really zero in on the demand. And the demand base has been rather torrid for soy meal, and obviously it's going to be hard for soybeans not to rally if there's continued good demand for soy meal. And I think that the report that came out from the USDA last week didn't give anybody any kind of real fear that demand is waning quite a bit, even though production numbers were upticked a little bit. Didn't give anybody real fear that the demand is waning, so I think that's why we're pushing right back up in the soybeans. So we'll see what happens there. We're still in that range and a sideways market. For wheat, the USDA kind of surprised the market by increasing wheat carryouts. They increased the other spring wheat and durum production by a combined about 2 million bushels or so, and that was after resurveying growers in North Dakota and Montana due to the late harvest that occurred. The balance sheet at this point for the U.S., import estimates were about 10 million bushels larger, and that's because of the massive crop up in Canada working its way down here into the U.S. So we got that supply side coming into the U.S., kind of pushing up the supply end of the equation for our balance sheet here in the United States. And then also, globally speaking, the USDA increased its 13-14 week carryout from its September forecast by about a little over 2 million metric tons to about 178.5. So a little bit bigger supply, and I think a little bit of surprise to the market there. So the USDA gave, something for us to finally sink our teeth into after waiting for 2 months, and now it's going to go back to some of the week-to-week and month-to-month items that we look at when we try to really gauge what the next direction in this marketplace is. As for wheat right now, obviously, we're going to go into dormancy. I already have with the winter crop, so we're just going to have to wait to see what happens when that comes out of there. So we're going to be watching some of the demand base around the world. When it comes to some of our competitors, for example, in France, they've planted about 81% of their soft wheat crop, and that's up from 70% a week ago. This was last week's numbers, and then up from about 75% the same time last year. So they're getting the crop in the ground at a little better clip than they had been last year. And, you know, when you add to the fact that the euro currency, with the dollar rallying strong, one impact that's happened is we're seeing deflated currencies or prices moving lower on some of the crosses there. And we've seen this lower trajectory for the euro recently, and obviously a lower currency for them is going to help, hopefully, you know, probably boost their demand base, which means it would steal some business from the United States. So I think that's weighing on our wheat market a little bit there too. And the other grain, corn, after, you know, absorbing the USDA report numbers, we had a rather sizable short position building by the funds. The non-commercial and non-reportable combined traders held a net short of about a little over 255,000 contracts, and that was through the report as of November 5th. So obviously a massive short position in that commodity. So if it does start to hold, then we start to see more of a push to the upside here, especially when you go week by week, because I think some of these bigger spec funds, they're not looking at day-to-day action, they're looking at week-to-week. We start continually to take out previous week's highs, then you might see a rush to the door to cover at least part of the position. And obviously that becomes a self-fulfilling prophecy on moving the market higher, because when you see a lot of people hitting the door at the same time and doing some massive short covering, that should prop the market up. So we'll see if that starts to come into fruition. You know, we'll get estimated numbers on the player sheets day by day to see if we're starting to see some continued fund short covering, because that could be a big driver of the prices, and we'll keep our eye on that one. And then, you know, really back to soybeans, just the oilseed equation. Robust demand on the soy meal side. There's just no doubt about it. Crush margins are still decent. We do have a couple things that are kind of working against prices. The Malaysian Palm Oil Board, they reported their oil stocks increased by about 3.5% in October, and their increase basically was due to a larger production number, kind of offset their exports and their strong domestic usage. So nonetheless, their stocks are building over there. So obviously that would depress prices and maybe give us a little bit of a heat to the downside also. And then the big drivers for soybeans and the oilseeds is going to be, over the next few months anyway, is going to be exports. Kind of have to continue to see if those are staying on the robust side. Weather developments in South America, and generally right now in South America, and in particular in Brazil, things are rather benign, and, you know, conditions are generally good. So I think that could be a pressure point coming on too. So plenty of information that came up from the USDA. The market's done absorbing it. It takes it, moves on to the next thing, and then we'll just have to continue to watch the development of the crop and worldwide trade to see if we can continue to get some business here in the U.S.
Okay, Bob, I heard last week that packers are finally back into the money, so finally seeing some positive break-evens there. We saw a cash trade last week, 131. Is everything setting up to see maybe a turn for those feeders?
Perhaps. You know, it's a massage those guys really have to do, and I respect the business they're in. It's tough when you're week to week having to deal with these cash markets and consumer demand and beef prices. I mean, so my hat's off to these guys, and I'm glad they finally got in the black. I think it actually helps the industry quite a bit when they're sitting in a favorable position like that. But, you know, we did have a little bit of a lower trade last week, 131 like you mentioned. That was $1 lower than the previous week in the south, and we traded steady up in the north this week. We're looking for maybe steady to maybe a buck lower. I think the market right now is sizing up about a 129 bid, 133 to 134 offer, right in there. I don't think we'll see much trade today or tomorrow, probably bring it in on Wednesday or so. Cutout values, the blended cutout, end of the week, it's 198.40, if I recall correctly. That was $1 lower than the Friday before. We're looking for a little bit of a sideways market this week, and then once we get through the holiday, maybe a push to the downside of the cutout values. So I think that could put some pressure in the live, and because you don't want things turning back in the red quickly again. That's for the blended cutout, and then same for the box beef that came out. It was down about 90 cents about mid-session on Friday, closed about $1.20 lower, I think, than the previous week. So maybe about $2 lower than the previous week. So on the cash side there, on the box beef side, showing a little bit of weakness. But nonetheless, if the live can kind of help us out and push down a little in prices, then I think that would help out the situation with the packers, and we think it stay pretty strong going forward. Market's robust from a pure spec perspective. When I talk to a lot of traders that I talk to, big and small, they're still willing to want to get into the long side of these cattle futures, especially if you move out farther, like into Feb and April. So any big dip to the downside that's not caused by some kind of unforeseen event out there, I think is going to find some good support. And that's kind of been indicated in the Commitment of Traders report that showed through November 5 again that the non-commercial traders had increased the length of their long side of the market by about 3,000 contracts. So, there's still, the spec side is still looking at rather tight supply out there, and that should be buoyant for the marketplace. And it's going to take quite some time for us to rebuild inventories, maybe, into the 2015 area or so. So I don't think there's too much fear that this market's going to fall considerably as long as demand stays relatively steady.
Okay, let's, again, we just covered a few commodities. I know you look at every commodity that's trading. If we wanted to talk one-on-one, how do we get in touch with you?
Sure, you can pick up the phone, give me a call. The number is 800-388-0998. You can also ping me on email, which is bmaurer, B-M-A-U-R-E-R, at mandukatrading.com. And then you can also just come visit us on the website there, which is mandukatrading.com.
Okay. Bob Maurer, Manduka Trading in Chicago, on today's Agribusiness Report.
Whew, hot enough for you?
Hey, life in the cornfield.